How are you saving for retirement? Do you have a 401k? How about a 403b, a SEP IRA? Simple. It gets confusing, so figure out what is the right retirement plan for you. Welcome everyone. Show's called Your Money, Your Wealth. Name's Joe Anderson, certified financial planner, president of Pure Financial Advisors. With my big man right there, Big Al Clopine. He's going to break a lot of good things down for you today because we have to re-energize your IRA. It gets confusing with the amount of plans that are out there and what's available, who qualifies, how much can you contribute. I have two plans, can I do both? We're going to break everything down and then we're going to show you how to reboost your overall IRA. That's today's Financial Focus. Hey, we have some really good news actually out there in the world of craziness. IRA balances, if you look 10 years ago, average IRA balance was about $64,000. You fast forward 10 years, that almost doubled to $111,000. Look at the 401k balances, almost identical to the IRA. And 10 years later, a little bit lagging, but still over $100,000. So we're seeing retirement accounts, they're doubling. Pretty cool. But here's another secret though, over 10 years the market has done pretty well, and if I just take a 7% rate of return over 10 years, that will double it. So don't let this surprise you or get you too excited because there's still a lot of work to do. To bring in the heavy lifting, let's bring in big man, Big Al Clopine.
So you knew we were going to talk about IRAs, right? Because we love IRAs. So today, we're going to talk about the basics, the ABCs. We're going to talk about contributions, maximizing them. Let's get into taxes, right? How to save taxes throughout retirement. And then finally, there have been some changes in the IRAs and Roth IRA world that you need to know about. And Joe, this is one of our favorite topics because IRAs, 401ks can make such a big difference in people's retirement lives.
Yeah. Did you like that?
Yes, I did. Yeah, I was amazed.
We were like, yes, we have some good news, but if they just sat at 64 10 years later at 7%.
You took the good news away.
I know I did, Al. There's a lot more work that needs to be done here. So look at this thing, it's just going bananas on me. So let's kind of dive in. When you look at contributions, right, so who can contribute? Interesting little tidbits here when it comes to IRAs that anyone can contribute to a retirement account as long as you have earned income. All right, so if you're 80 years old and still have earned income, you can contribute. If you're 10 years old and have earned income, you can contribute. So that was something that was a little different this year with that 70-year-old or 70 and a half could not contribute to retirement accounts. They kind of waived that, no age restrictions.
That's right, because and it used to be just a Roth IRA. You could contribute at any age as long as you or your spouse had earned income. But now the IRA, at any age, you can contribute as well. So since you can, then let's take a look at, Joe, how much you can contribute.
Yeah, well, before we do that, here's another couple confusing aspects of this. There's something that's called a spousal contribution. So let's say that I'm working and my spouse is not working, or vice versa. As long as one spouse has earned income, both spouses can contribute to a retirement account. So there's this earned income requirement, but if you're married, only one spouse needs to have earned income for both of you to be eligible to contribute to those retirement accounts. So you can still work part-time. So the limitations in regards to the contribution is the earned income, or up to $6,000 or $7,000 depending on your age. So if you're only making $3,000, then you could only contribute $3,000 into a retirement account, or you can max it out at $6,000. Or if you're over 50, then you can put in that catch-up.
Yeah, exactly right. So you're right, Joe. $6,000 is the amount for the current year. An extra $1,000 if you're 50 and older, so that's $7,000 for a regular IRA or a Roth IRA. And you can mix and match. If you want to do $3,500 and you're over 50, let's say in a regular, and $3,500 in a Roth, that works just fine. You just can't go over that $6,000 or $7,000 limit.
Yeah, great point. It's $6,000 total, so it's not like $6,000 for the Roth, $6,000 for the IRA for a combination of 12. You can mix and match, but it's $6,000 or $19,500 for the 401k plan, $26,000 if you're over 50.
Yeah, and then Joe, as far as can you take a tax deduction? So if you're single and you're in a retirement plan already at work, let's say, so if you make less than $65,000, you can still take that full deduction for an IRA. The phase out is $65,000 to $75,000. If you're married, the phase out, I believe, is $104,000 to $124,000. I remembered.
Yeah, because then if you want to contribute to the 401k plan, right? So I'm taking a tax deduction there, but I also want to contribute to an IRA. Can I do it? The answer is yes, but can you take the deduction? Then you have to take a look at your adjusted gross income. So if you're single, it's around $60,000.
65. Yeah.
65,000. If I'm married,
104.
104.
Yes.
If you don't have a plan, right, then there is no income limit. Roth IRAs are a little bit different. So if you're married, it's $196,000 is the start of the threshold, and if you're single, it's $124,000. So just understand, if you're making over $200,000 as a married couple, you probably don't qualify for a Roth IRA. And if you make more than, let's call it $130,000, just rough numbers, as a single person, you probably are not eligible for a direct Roth IRA contribution. That doesn't mean you can't get money into a Roth, because there's no income limitations for 401ks, which is oddly enough. If you make $1 million a year and you want to put money into a Roth 401k, and if you have that eligibility through your employer, you can.
And it's one of those things, there's differences between IRA rules, 401k rules, so you just have to understand what they are. So let's talk about investments. So when you're thinking about investments in a Roth IRA or regular IRA, typically people put stocks and bonds, mutual funds, ETFs, index funds. That would be the most common. But that's not the only way and only thing you can invest in. You can set up what's called a self-directed IRA, and you can put things like real estate, precious metals, cryptocurrencies, things of that sort.
Yeah, we get this as like, well, what does a Roth IRA pay? Right?
Yeah, right, exactly. I went to my bank and they said they're paying 1%, so I don't want a Roth. They're no good.
Yeah, or my Roth IRA is no good because I've lost money in my Roth IRA. Just understand that the Roth or the IRA is just a shell. Then you can invest in basically anything that you want besides collectibles and insurance, right? That's about it. So if you like CDs, or if you like mutual funds or stocks, if you want to buy Amazon, right? Hit $2 trillion market value. Let's do that. You could do that inside these retirement accounts. So just understand that it's a shell that allows you to either take a tax deduction, let it grow tax deferred, and then when you pull the money out, it's taxable. Or you could avoid or disallow, or another word is just to don't take the deduction and then let it grow tax-free. So that would be a Roth. So it's the opportunity is endless. It's just really understanding the rules.
Yeah, and I think we get this question all the time: is should I own real estate in my IRA or my Roth IRA? In many cases, in most cases, we say that's not necessarily the best approach. There's a lot of reasons why. You have to take a required minimum distribution. You may not have cash to do it. There's no step up in basis when you pass away. You don't get depreciation deductions. So I'm not saying it's terrible. I'm just saying it's not necessarily the best.
Hey, and we got a special gift for you once again today. Go to yourmoneyyourwealth.com, click on that special offer, because it gets confusing on what you qualify for. If you're self-employed, if you have a 401k through your employer. So we created a white paper for you. It's called 8 Types of IRAs. It's our special gift for you today. Go to yourmoneyyourwealth.com. 8 types of IRAs. You probably thought there was just one. Guess what? There's 8 of them. I didn't even know that. Go to yourmoneyyourwealth.com. We got to take a break. We'll be back in just a second. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Alan Clopine talking about retirement accounts, re-energizing your IRA. Go to yourmoneyyourwealth.com and get our white paper. It's 8 types of IRAs. 8 types of IRAs. Breaks everything down to see what you qualify for, what makes sense for you. You probably didn't know that you had an opportunity to potentially save a little bit more money. Go to yourmoneyyourwealth.com to click on that special offer. Al, let's go to the true-false question.
A parent can fund a child's Roth IRA if they have earned income equal or greater than the Roth IRA contribution. That is a true statement, and we get this question all the time from parents, grandparents. Can I put some money into my kid's Roth account or IRA account? In some cases, a grandparent wants maybe their grandson, granddaughter is a year old. Can I put money into the Roth? The answer is yes, if they have earned income.
Yeah, that is a very common question. Hey, I really want to get my kids set up in retirement, and I want to give them the opportunity to save, so I'll actually fund the retirement account. Well, yes, you can give your kids a gift and put it directly into the account. They can't touch it, but they have to have earned income. So, Al, do they have to file a tax return? Let's say if they have a paper route or something like that. What's kind of the rules behind that?
That's a great question, and I would say no, not necessarily. Although they could be questioned, Joe. I mean, because if you don't file a return, then it doesn't necessarily show that you have earned income.
The stickler. Let's get into saving money here, because if we're looking at this, there's combinations that you can do. So maximum contribution for an IRA is $6,000, which we talked about. If you're over 50, it's $1,000. So $7,000 is what you can contribute into an IRA or Roth IRA, right? Mix and match. But then 401k, we get this. It's like, well, hey, if I have a 401k, can I still contribute to an IRA? Or I have a 401k at work, I cannot contribute. No, that's false. The maximum contribution for 401ks is almost $20,000. And then $6,500 is the catch-up if you're over 50, so 26 grand. So then if you have a match, if you're lucky, right? So that's $30,000 of savings. So let's say if you're in your 50s or 60s and you're in your max earnings years and you don't feel like you're quite there, this is really to re-energize your retirement, right? If you can find a way to scrape up a couple of bucks here, you can see the compounding. Combined, it's about 37 grand. Yeah. So it's a big deal of how much money people could save.
It's huge, and of course 37,000 is a big number. We understand that. But we have a lot of people that come to our office that are in their early 50s or even 60s and they haven't started yet, and it's like, well, you're a little behind. Hopefully you're in your highest income earning years, and so what can you do in terms of savings? And so Joe, we kind of want to talk about the possibilities here.
Yeah, let's say if I'm looking at this, you got 5 years, if you can max this out at $37,000, all right, well now you have $213,000 in 5 years. I mean, this is no chump change. If you got 10 years, let's say you're 55, you want to retire at 65, and you can max out both IRAs and 401k, right? Now you're talking about $500,000. If you're let's say you're 50s, right? You want to retire 70s. It's huge. It's huge, right? Of course, this is hypothetical. It's compounding, I think.
It's 7%.
7%, right? If you run this at 6, it's going to be a little bit lower. If you run it at 8, it's going to be a lot higher. But I think where people get confused too is that, all right, well, if I save all of this money into a 401k plan, I'm going to have a pretty good balance or ending balance. But another thing that you have to consider is, where are you saving the money? Right? So let's talk taxes here, Al, because I believe, and I think our listeners and our viewers think that these might go up.
Well, I think they may, and so this is going to be fun for me, Joe, because I'm the CPA tax guy, but I get to watch you talk about taxes because you are so passionate about them.
Oh, see how he just throws it back to me? He's like, no, I don't want to talk about it.
I'm going to sit here and watch you.
So here's where you got to go with this. Is that this is your standard 401k plan, right? It's tax deferred. So when you put money in, you get a tax deduction. It grows tax deferred, and when you pull the money out, right, then that's when you pay the tax. This is the Roth IRA. That's tax free. So you don't get the tax deduction going in, but when you pull the money out, it is tax free. Well, where do I put it in? Do I put it in the Roth, or do I put it in the pre-tax? Well, first you want to make sure that you understand what tax bracket that you're in, because we're in a marginal tax system here in the US and people get a little bit confused. So this is married filing jointly, okay? So let's say that a couple makes $100,000 a year gross, right? So then you look here and it's like, well, $100,000 falls right there. So does that mean they're in the 22% tax bracket? The answer is no, right? Gross income is one thing, taxable income is something completely different. You take your gross and you minus your deductions, and then let's say 401k contributions. 100,000 gross, you put 20,000 into a 401k plan, another 20,000 deduction, so that's 40,000 bucks. So my taxable income in that case would be 60 grand. Your first roughly $20,000 of the 60 is going to be taxed at 10%, and then the remaining 40,000 will be taxed at 12. So you don't even touch the 22% tax bracket. So when you determine where you want to look at savings, you have to understand where your tax bracket is, okay? Because if I'm in these lower tax brackets, 10, 12, maybe even 22, it might make sense for me to go straight Roth because I'm not getting a huge savings here from a tax perspective. If I'm in these larger tax brackets, well, then I got a lot bigger bang for my buck. But what we find is that a lot of you have all of your money here and you're doing a good job of saving. Maybe you start maxing this thing out. Now you got $1 million in here or a couple million bucks. Well, just know that every dollar that comes out of here is going to be taxed at ordinary income rates. Tax rates are going to go up in the next few years, just how the law is stated today. So you want to look at making sure that you have the right balance of where you're saving your money so you don't kind of trap yourself into one pool here where potentially the tax savings that you got today, you're going to end up paying a lot more tax on the other side of the road. Okay? So tax diversification is key. That can help you stretch your dollars out even more.
Yeah, and I think what we find, as you said, Joe, is most people have the bulk of their savings in tax deferred. Then you add a pension and Social Security on top of that, which are taxed at ordinary income. Maybe you got a rental property taxed at ordinary income, which is the highest of tax rates. That's why we're very we really like the Roth IRA, the tax-free. So consider Roth contributions, 401k Roth contributions, Roth conversions, taking money from your IRA 401k, converting it to a Roth. Yes, you pay taxes currently. Tax rates are lower today than they have been and probably lower than they will be. So it's a great time to think about Roth accounts.
Yeah, without question. I think it's just really understanding what your goals are, what you're trying to accomplish, how much money that you're saving, what these ending balances are going to be, right? What other sources of income that you have, right? It's just start putting your plan together, put it on paper. If you need help to understand what IRAs are available for you, just go to our website, yourmoneyyourwealth.com. We got 8 different IRAs. It's awesome. It's a really good read. If you have trouble going to sleep, I would highly recommend downloading that white paper. We'll be back in just a second. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here with Alan Clopine. We're talking about IRAs. Go to yourmoneyyourwealth.com. Click on that special offer today. It's 8 types of IRAs. Can you believe it? There's 8 of them. Bet you don't know what they are. That's why you got to go to yourmoneyyourwealth.com. Click on that special offer. It's absolutely free of charge. Our gift to you. Let's see how you all did on the true-false question.
If I'm over 59 and a half, I can donate to a charity directly from my IRA. True or false? Well, that actually is false. You can do that, but you have to be 70 and a half. In fact, let's go over that. That's called a qualified charitable distribution. Okay, so 70 and a half, you can donate up to $100,000 per person if you're married, $100,000 each, $200,000 from your own IRA. Why would you want to do that? Well, if you do that, it doesn't show up as income. Now, you don't get the tax deduction for a donation, but many of you are not itemizing anyway, so you will end up saving taxes by doing the QCD if you're over 70 and a half. And also, if you have to take a required minimum distribution, it counts for that required minimum distribution. So Joe, this is something that was a temporary law. It kept getting extended, but now it's a permanent law. So
explain to me, all right, so let's say if I give to a charity, right, I get a tax deduction for that gift. So if it's $50,000, I can write it off on my tax return if I itemize. But with the new tax law that came out, a lot of retirees potentially are not itemizing their deductions anymore because of the state tax and everything else. So the QCD is something that they can still give to charity but get a lot bigger bang for their buck in regards to a charitable gift.
Exactly. So let me give a quick example, right? So a typical retired person might have $10,000 of what might be itemized deductions because for their taxes. And if they give $5,000 to charity, that's $15,000, but the standard deduction is about $25,000. So they're not really getting any benefit for that. So if they take the required minimum distribution for 10 and do a deduction for 10, now their itemized deductions show are at $25,000, same as standard deduction, yet they have to pay the tax on the required minimum distribution.
Correct, because the RMD comes out, it's going to show up as income. And then if they take that and give it to a gift, they had to pay tax and then give it to a gift and then take the tax deduction, but they weren't able to get the tax deduction because they weren't itemizing.
Yeah, and furthermore, Joe, there's a few things. When you have higher adjusted gross income, more of your Social Security may be taxable, maybe less of your rental property losses are deductible, maybe your net investment income tax is higher, so there's a lot of reasons to get it off your 1040.
Yeah, RMDs. So we're talking about a required minimum distribution. A few changes here is that it was 70.5 for many years. With the Secure Act that was signed in December of 2019, is that it pushed the required distribution from 70.5 to now age 72. But then you have the CARES Act that came in that was signed in March to say, hey, you know what? You do not have to take a required minimum distribution. You don't have to take it if you don't want the income and show up on taxes.
Yeah, and so that was, we were all set for the 72 rule, which is true. It just, everything got waived for the current year, so you don't have to take your required distribution. Now, going forward to 2021, what if you're supposed to take a required minimum distribution and you forget? Well, it's a 50% penalty, 50% penalty. So that means if you were supposed to take a $20,000 required minimum distribution, the IRS is going to make you pay $10,000 for the penalty. Oh, by the way, you still have to pay the tax on the $20,000. So be careful. Don't forget not taking the RMD.
Right, you take $20,000 out plus another 50% penalty, plus the tax on the 20, and it could get. It's one of the most egregious tax penalties in the code.
It really is. Something else, Joe, I want to bring up is the Stretch IRA. So this was with the Secure Act, which was passed at the end of last year. So beginning of 2020, you can no longer do a Stretch IRA. So the old rule was that when you passed away, your beneficiaries over their lifetimes, non-spousal beneficiaries, could stretch that required minimum distribution over their life. And so they would just take a little bit out each year. Now, under the new rule, the individual, the beneficiary that gets the account has to take the money out within a 10-year period, meaning that a lot of folks are going to have much higher taxable income because they have to take a bigger chunk out. Now, realize with the new Secure Act, you don't have to take out an even amount over 10 years. You just have to take it all out by year 10. So in some cases where people are receiving beneficiary IRAs, then what you may want to do is take low distributions if you're working in a higher bracket, and then when you retire, within that 10-year period, you take higher amounts then. So Joe, there's a little bit of planning there.
Let's go to Ask the Experts.
I make too much money to get a tax deduction for my IRA contributions. Is it better for me to put money into a regular investment account rather than an IRA? We do get this question a lot. In other words, I can put the money into an IRA, but I don't get a tax deduction. It'll grow tax deferred, but when I pull it out, it's all ordinary income. Or should I just leave it in my non-retirement account because when it grows, it'll be capital gain? So Joe, what say you on that?
Oh, well, it depends on Julie's situation. If she does not have any other IRAs, I would absolutely do a non-deductible IRA and then immediately convert it into a Roth IRA. Because you're a high wage earner, you can't take the deduction, but there is no income limitation on Roth IRA conversions. This is called a backdoor Roth IRA. So you make that non-deductible IRA contributions and then you convert it into a Roth IRA. It's basically kind of a loophole in the overall IRS code. But if you do have other IRAs, they look at an aggregation and pro rata rules, so it gets a little bit more complex. So you want to make sure that you understand the rules before you start dumping money into non-deductible IRAs and converting them, and then you'll call me and say you don't know what the hell you're talking about, but you probably made the mistake.
Yeah, we do get that a lot, and that's exactly right. Sometimes it does make sense, sometimes it doesn't. It depends upon your situation. So if that, Julie, with your situation, maybe get a little bit more help, we need a little bit more information, we can help you out a bit.
Hey, what did we learn today? Well, we learned that there's 8 types of IRAs. I learned that as well. You can go to yourmoneyyourwealth.com, click on that special offer. 8 types of IRAs, but we also got through the ABCs of IRAs, right? How much can you contribute? Who can contribute? You know, a lot of questions on, hey, I want to help my kids and grandkids out. Well, yeah, you can as long as they have earned income. How do you max it out? If you can max it out, catch up on your savings, I think that's great. And then we looked at a little bit of tax strategy. Should you go the Roth? Should you go the traditional? Maybe you do a little bit of both. Should I do a conversion? And then recent changes. We got the CARES Act, the Secure Act. We're going to get a CARES Act 2.0. Who knows? There's going to be a lot of changes that are coming up in the years to come. There's trillions of dollars of stimulus that are help relieving our economy, but it has to be paid for at some point. So if you're not planning on your IRA right now and re-energizing it, you might be losing out. Go to yourmoneyyourwealth.com, click on our special offer. That's it for us. Join us next week. I'm sure we're going to talk about retirement and IRAs. Maybe so. What do we got?
Don't we always?
Yeah, it's going to be great. We'll see you next week, folks. Have a good weekend.